Hare Krishna. Welcome to TaxGuru YouTube channel. This is C. Rohan Arpingai, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to the video series on Income Tax Act 2025. And today is episode 6. So let's dive into it. Let me allow to share my screen. Yes. So, welcome back to episode 6 of our complete Income Tax Act Master Series. So, in this episode, in earlier episodes 4 and 5, we began learning the language of the Income Tax Act. So, we first understood the basic expressions person, assessee, assessment, tax year, income, and total income in earlier episodes. Then in episode 5, we moved into the definitions relating to the capital asset, business, profession, company, firm, partner, agriculture income, dividend, transfer, property, virtual digital asset, and other important exposures. So today in this session, that is episode 6, we complete our third three-part journey through the most important foundational definitions. But today's episode takes us into a particularly important area, that is, we will study definitions that answer three fundamental questions. What are they? First, where is the taxpayer resident? Second, where is the taxpayer's economic activity located? And third, who is responsible for complying with income tax law on behalf of another person? So these three questions take us into the world of resident, non-resident, resident but not ordinarily resident, permanent establishment, international transactions, specified domestic transactions, persons responsible for paying, then income tax authorities, CBDT, legal representative, and representative assessee. So these concepts are particularly important because a residential status determines what the scope of taxable income. So that is very much important. So for example, a resident is generally subject to a wider scope of taxation than a non-resident. And a resident who is not ordinarily resident occupies a special middle category. So similarly, in international taxation, the existence of a permanent establishment may become critical and plays an important role in determining whether business profits of a foreign enterprise or company can be attributed to India under the applicable domestic law and treaty framework. So the transfer pricing introduces another vocabulary, that is associated enterprises, international transactions, specified domestic transactions, and arm's length pricing. So we'll study and cover this today in this episode. And finally, tax administration requires us to understand who acts when the taxpayer himself cannot or doesn't discharge the relevant obligations. So that brings us to the legal representatives and representatives assessees. So, as we study each concept today, I want you to keep one principle in mind. What is that? Residential status is not the same thing is that is of like citizenship. It is a different concept altogether. So, representative capacity is not the same thing as a beneficial ownership. An international transaction is not merely a transaction in foreign currency. And permanent establishment is not simply an office or a branch in every situation. So keep this in mind. So we shall examine each of these distinctions carefully in today's episode. So we shall also compare the Income Tax Act 2025 with the Income Tax Act 1961 wherever possible, so that we can understand not only what the new act says, but also what has actually changed and what has merely been renumbered or redrafted. So let us begin with one of the most important concepts in the entire income tax law, residential status. So moving further, let's see the central question, where is the taxpayer resident? So residential status is one of the first questions that must be answered before determining what the scope of the total income. So a person's residential status is determined for a particular tax year. Now we are using the word tax year. Everyone must be known this fact that from the financial year 26-27, a term tax year is used completely and widely in the next part. So it is not a permanent label. A person may be resident in one tax year, non-resident in another. So, and where the statutory conditions are satisfied, resident but not ordinary resident in another, that is also another case. So the important point is here that the residential status is determined according to what? Statutory test. It is not decided merely by nationality, citizenship, as I said, possession of a passport, place of birth, or ownership of the property. The Income Tax Department expressly confirms that the basic individual residency conditions under the 2025 Act continue the principal test of the 1961 Act. So nothing changed on that particular ground. Please note that. Next, let's see resident, the basic framework. Under Section 6 of the Income Tax Act 2025, residential status is determined by statutory conditions. For an individual, the two principal tests, that is test 1, stay in India for 182 days or more during the relevant tax year, and under test 2, stay in India for 60 days or more during the relevant tax year and 365 days or more during the 4 preceding tax years, subject to the statutory exceptions. So same as per the Income Tax Act 1961, same conditions are continued. So the department's current guidance confirms these basic conditions and states that there is no fundamental change from Section 6, subsection 1 of the 1961 Act. So this is important because students or professionals often learn the 182-day rule and forget that the alternative test also exists. So the second condition is also important of 60 days and previous 4 year 365 days. Moving further, let's see residential status, the 182-day test. So the first test is comparatively straightforward. If an individual is present in India for 182 days or more during the tax year, the person satisfies the primary residence condition. For example, suppose an individual stays in India for 190 days during tax year 26-27. The individual satisfies what? The 182-day conditions, and therefore the person is a resident subject to the statutory framework and the applicable special provisions. So notice the terminology. Under the 1961 Act, we generally refer to the previous year, and now we are using the word, as I said, tax year. So this is one example of the transition from old terminology to the new legislature architecture. Everything remains the same. Moving further, let's see residential status 60 plus 365 days. So here, the second principal test is more sophisticated. The individual must satisfy what both under this stay in India for at least 60 days during the relevant tax year and stay in India for at least 365 days during the 4 preceding years. These both conditions need to be satisfied to become a resident. Suppose current tax year 75 days, that is 26-27, and previous 4 tax years 400 days. So the person satisfies both these requirements and therefore subject to the special exceptions applicable to the particular categories of individuals, the person may qualify as what? A resident. So this is why residential status computation requires a historical travel record. So it is not enough to look at the current year alone. We need to see the previous four tax years. Moving further, let's see special rules for Indian citizens and persons of Indian origin. Very important. So the legislation contains what? Special rules for certain Indian citizens and persons of Indian origin visiting India. So the Income Tax Department's current FAQ confirms that new Act retains basic framework from 1961 Act, while the special rule for persons having total income other than income from foreign sources above rupees 15 lakhs modifies the 60-day threshold to 120 days in the relevant situations. Very important to note what? Special rule persons having total income other than income from foreign sources, if it exceeds rupees 15 lakh, then the 60 days it will be replaced by 120 days in the relevant situation. So this is the critical examination point. So we should not be mechanically apply 60 days plus 365 days to every person. So the statutory exceptions and modifications must be checked. Let's see now deemed residents. What is here? So the concept of deemed residency is particularly important. An Indian citizen having total income other than income from foreign sources exceeding 15 lakhs may deemed to be resident in India, where the statutory conditions relating to liability to tax in another country or territory is satisfied. So here important point is what? Physical stay in India is not the determining factor in this deemed residency rules. Very important. So this, 60 days, 120 days, nothing. The provision addresses situations where an individual may not satisfy the ordinary physical presence test, jurisdiction test, but it is not liable to tax in another jurisdiction because of domicile, residence, or similar criteria. So the department confirms that this rule has been written in the Income Tax Act 2025, also corresponding to the section 6 subsection 1A of the 1961 Act, very important, and now appearing in section 6 subsection 7 of the new Income Tax Act 2025. Very important. That is deemed resident concept. Moving further, let's see resident of in case of HUF. So residential status is not limited to the individual. The Act also provides rules for Hindu undivided families, that is HUF. And HUF may be resident or non-resident. Residential status analysis involves what? The location of control and the management and the statutory provisions relating to the HUF. So the concept of not ordinarily resident is also relevant to an HUF entity in the circumstances specified by section 6. So this becomes particularly important for HUFs having foreign business, overseas assets, foreign income, or family members outside India. Let's move further. Let's understand residential status of the companies. So for companies, residential status operate differently. An Indian company is resident in India always, whereas a foreign company may become resident if its place of effective management, commonly known as POEM, that is place of effective management, is in India during the relevant tax year, subject to the statutory framework. So the Income Tax Department confirms that the residency test for companies has not changed under the 2025 Act. It is same as it is in 1961. So an Indian company is resident while a foreign company is resident where its POEM, that is a place of effective management, during the relevant tax year is in India. So this distinction is crucial, and for individuals, we focus heavily on the physical presence, and whereas for companies, we focus on the legal incorporation and effective management. Now let's understand residential status of the firms, AOP, BO, and other entities. So here for entities such as partnership firms, AOPs, BOI, local authorities, artificial juridical person, residential status is determined with reference to what? The location of and control of and management. Location of control and management. So the Income Tax Department's current residential status guidance confirms that such entities can be resident or non-resident but do not receive the RNOR classification. Very, please note down. This entities cannot be can be a resident or non-resident but do not receive the RNOR classification, that is resident and not ordinary resident classification. So the key distinction is individuals, HUFs can have the additional RNOR resident, not ordinary resident classification, but other entities generally do not have. Let's see resident but not ordinarily resident, very important. So now we can come to one of the most important concepts. RNOR is not the same as non-resident. Please note down, a person classified as a RNOR is first what? Resident. So only after becoming resident do we ask, is the person ordinarily resident? If the answer is no, the person becomes RANOR. So this is therefore a secondary classification. The concept is particularly important because the scope of foreign income taxable in India for RNOR is narrower than that of for a resident and ordinarily resident. So let's see the two traditional tests under the RNOR. An individual may be RNOR if non-resident in 9 of the preceding 10 tax years or stay less than equal to 729 days in preceding 7 tax years. Same as the Income Tax Act 1961. So the department confirms that the criteria have not been modified under the Income Tax Act 2025 Act. It is same as section 6, section 13 correspond to section 6, subsection 6 of the 1961 Act. So Section 6, subsection 13 is what under Income Tax Act 2025. So this is an excellent example of a provision where the substantive rule has largely continued while the new act changes only the terminology from previous year to tax year, and nothing has been changed on any conditions which are continued in a new act. So moving further, let's see additional RNOR categories. So the new act also carries forward what the additional categories of RNOR associated with certain Indian citizens or persons of Indian origin visiting India and satisfying what the specified income and stay conditions, and Indian citizens who are deemed resident. So the statutory framework must therefore be read as what whole. Do not assume that RNOR is determined only by the 9 out of 10 and 729-day test. Okay. So there are additional statutory routes to RNOR status. So let's moving further understand resident versus RNOR versus non-resident, right? So here this is one of the most important classification tables in the our today's episode. So the resident and ordinary resident, the person is resident and doesn't fall within the RNOR category. And under the RNOR, the person is resident but satisfied the statutory conditions for not ordinarily resident status. And under non-resident, the person doesn't satisfy the residence conditions. So this classification affects the scope of taxable income. Very important. So the basic conceptual sequence is therefore step 1, determine what resident or non-resident. If resident, then determine second whether resident is an RNOR or ordinary resident. That is what important. Now let's understand scope of total income. Why residents matter. So residential status becomes meaningful because it determines what your scope of total income. Under Section 5 of the Income Tax Act 2025, a resident is generally taxable on income received, deemed received, subject to the RNOR rule, foreign income. So for an RNOR, foreign income is brought within the scope in the circumstances specified by the Act, including what where it is derived from a business control in India or a profession set up in India. For non-resident, the scope is principally limited to income received or deemed to received in India or accruing or deemed to accrue or arise in India. So this is why residential status should always be determined before undertaking a complete taxability analysis of the income. Now moving further, this episode would be little longer than regular, and under the as we are learning the law, it will definitely every episode will be minimum of 45-50 minutes. So have a good time, sit down and listen to this. So this is an important conclusion from our comparison under the 1961 and 2025 Act. The Income Tax Department specifically confirms that the basic individual residential country have not changed. Everything is remains the same. So now moving further, let's understand transition, which act applies. Okay, very important. So this is an extremely important, the Income Tax Act 2025 applies from 1st April 26. So residential status for a tax year beginning from before 1st April 26 continues to be determined under which act? 1961. So for tax years beginning on or after April 2026, the 2025 Act will be applied. So the department expressly clarify that there is no overlapping application for the same tax year. Let's see non-resident statutory meaning. Now we will see the factor of non-resident. So Income Tax Act 2025 defines non-resident in section 2 subsection 72 as a person who is not a resident. So this appears simple, but there is an important statutory qualification. For specified provisions, section 161, 174, and 312, the definition of non-resident also includes what? A person who is not ordinarily resident under section 6, subsection 13 of the India Income Tax Act 2025. So this is subtle but very important bare act point. It means that the expression non-resident cannot always be interpreted identically throughout that. So context matters. Let's see misconceptions under the non-residents, the common misconception. So there are five common misconceptions. We can say a foreign first, a foreign citizen is automatically what non-resident, not necessarily. A foreign citizen may become resident under the statutory test also. Second misconception, an Indian citizen have a living abroad is automatically what? Non-resident. No. Statutory tests and special provision must be applied before come to the conclusion. Misconception 3, owning a foreign house means non-resident. Incorrect. Completely incorrect. Then misconception 4, having an overseas bank account makes a person non-resident. This is also incorrect, right? So, and misconception 5, citizenship determines the tax residence. Again, incorrect because residence is determined by the Income Tax Act statutory test. Follow that test, see whether that test is applied, and then you come to the conclusion. Moving further, let's see permanent establishment. So now moving from residential status to international business presence. The concept is permanent establishment, commonly called is what? P. Under section 173 clause C for the transfer pricing provisions, permanent establishment includes a fixed place of business through which the business of the enterprise is wholly or partly carried on. So this concept is crucial because what a foreign enterprise is what may conduct business in India without being incorporated in India. So the tax law therefore needs a mechanism to identify those when the foreign enterprise has sufficient business presence and we can charge them. So that is where the permanent establishment becomes what important and plays a crucial role. So let's understand permanent establishment core elements. So the basic P concept can be remembered through four elements. Place. There must be a business location or a place. Very important. Then it should be fixed. The place must possess the required degree of permanence. Then business. Business must be carried on through that place. And then the enterprise. The activity must relate to the enterprise. So Barrett uses the expression fixed place of business through which the business of the enterprise is wholly or partly carried on. So the key phrase is through which. The place must therefore have a business function. That is to main understand. Let's understand by examples of fixed place of P. So in treaty practice, a fixed place P can commonly involve places such as a branch, an office, a factory, workshop, a place of management. But most of the time, students or a professional must need to be very careful. A physical location doesn't automatically become a P in every situation. Applicable tax treaty may contain a more detailed definition. So therefore, the domestic law concept must always be read together the applicable treaty law where the treaty relief is being considered. So that need to be those who are in that need to read and go through that treaty. Let's see. P under the 1961 Act, whereas under the 2025 Act. So this is another excellent example of continuity. Nothing much has been changed. 1961 Act Section 92F contained the definition of permanent establishment for transfer pricing purposes, where under the 2025 Act, the corresponding definition is located under Section 173 Clause C. So the wording retains the core idea of the fixed place of business through which the business is wholly or partly carried on. So therefore, the principal change is structural rather than conceptual, we can say. Now let's understand international transaction definition. So now one of the most important concept we are going to understand under the transfer pricing. So section 163 of the Act 2025 defines international transaction. The basic requirement is what? A transaction between two or more associated enterprises where at least one of them is what? Non-resident. So this is what important under this. A transaction merely involving a foreign currency is not automatically an international transaction. The currency, not the part to determine that it is an international transaction. So similarly, a transaction between unrelated parties is not automatically an what? International transactions for transfer pricing purpose. So the statutory ingredients must be satisfied. let's understand what transactions can be international transaction. So the definition is deliberatory, what comprehensive enough. Section 163 includes transactions involving the tangible property, that is a purchase, sale, transfer, lease or use of machinery, equipment, vehicles, commodities, articles, and other things. Then intangible property includes what? Copyright, patents, trademarks, licenses, franchises, know-how, commercial rights. And then under financing, we can say that includes lending, borrowing, guarantees, securities, advances, deferred payments. And under service category, consultancy, technical services, legal services, accounting services, research, repairs. And then under business restructuring, transactions involving business reconstruction or reorganizations are also covered. So sections 163 statutory formulation is therefore significantly broader than what simply cross-border sale of goods is what need to understand. Let's very important term understand deemed international transaction. So a sophisticated part of section 163 we can say is a deemed international transaction rule. Suppose an Indian enterprise deals with an unrelated third party. Ordinarily, the transaction is not between the associated enterprises. But suppose there is what a prior agreement between the third party and the associated enterprise, or the terms of the transactions are in substance determined between the third party and the associate parties, then we can say it as they follow the internal satisfies the conditions of the deemed international transaction. So the if the statutory non-resident conditions are satisfied, the transactions can be deemed to be international transactions between the associated enterprises. So this rule prevents what taxpayers from avoiding what transfer pricing rules by routing transactions through an intermediary or unrelated party, and that is why these concepts come into the play the crucial role. Let's have a differential comparison international transaction under 1961 and 2024. So the basic architecture of international transactions substantially preserved. Section 163 corresponds to the section 92B of the 1961 Act. So key ingredients also remains the same. Major changes renumbering and restructuring, nothing more than that. Now moving further, let's understand specified domestic transactions meaning. So here, section 164 of the Income Tax Act 2025 provides that chapter 10, a specified domestic transaction means what? Specified transactions which are not international transactions and fall within the statutory category. So the definition includes specified transactions under provisions such as section 122, 140 subsection 9, 140 subsection 13, specified transactions under other relevant provisions, specified transactions involving eligible entities, and other specified transactions. So importantly, the aggregate value of such transactions entered into by the assessee in a tax year must exceed how much? 20 crore for the statutory SDT framework to apply. So the Act 2025 thus carries forward what transfer pricing treatment of specified domestic transactions and same and as per the Income Tax Act 1961. So nothing has been changed on this ground. So 20 crore limit is also, that threshold is also continued. That is what important. Let's see international transaction versus specified domestic transaction. So here we should not be confused over the concepts. An international transaction has an international element involving associated enterprises and at least one non-resident, whereas the special domestic transaction is a domestic transaction specifically brought within the chapter 10 because it falls within the statutory categories. The common feature is that both are subject to arm's length principle. So let's understand that arm's length principle. Okay. So here, the arm's length price is not one of the primary definitions listed in today's episode. It is impossible to understand international transactions and SDT is without it. So new one need to understand the arm's length price. So section 173 clause A defines arm's length price as a price applied or proposed to be applied in a transaction between persons other than associated enterprise under the uncontrolled condition. So the fundamental question here is what price would independent parties have agreed upon? So the transfer pricing attempts to answer that question. Let's see, person responsible for paying. So the expression person responsible for paying is particularly important in where under the TDS provision. So section 402 subsection 27 of the Income Tax Act 2025 specifies who is regarded as a responsible for paying in different situations. For salary, it generally refers to the employer, where the employer is a company itself, including its principal officer, is covered. For payments to non-residents, the payer or relevant person specified by the provision may be responsible. And under a government payments, the drawing and a distributing officer or other responsible person is covered. So the definition is a what transaction specific. Let's see person responsible for paying why it matters. Why this expression plays an important role? Because TDS liability must attach to a responsible person. So the act may require the person responsible for paying to deduct tax, deduct it at the correct time, deposit it, furnish the statements, and issue the certificates and maintain the record. So failure can lead to consequences under the act. So therefore, when a tedious question arises, do not immediately ask what is the tedious raised. First, ask who is the person responsible for paying. Then ask why, what payment is being made, and then when is the tax required to be deducted. One can need to ask. So this is what the sequence and prevents what many errors in futures. So the comparison between the both previous act and current act is that expression under the 1961 act was contained in section 204 of the Income Tax Act 2025. So the substance is substantially carried forward. Major change is placement within the new act CDS chapter and updated cross references only. So now moving further, let's see income tax authorities, right? So here the Income Tax Act doesn't merely impose what tax, it establishes an administrative hierarchy to implement what law. So section 236 of the 2025 Act lists the classes of income tax authorities. What are they? CBDT, Principal Directors General, Principal Chief Commissioner, Director General, Chief Commissioner, Principal Directors, Directors, Commissioners, Additional Directors, Joint Directors, Deputy Commissioners, Assistant Directors, income tax officers, tax recovery officers, and then inspectors of income tax. So this is what the hierarchy. Let's just as I actually whatever I have speak, that was the hierarchy only. So you can see in the slide for your ready reference. So now let's understand CBDT, Central Board of Direct Taxes. So it defines board, the Act 2025 defines board in section 2, subsection 18 as the Central Board of Direct Taxes constituted under the Central Boards of Revenue Act 1963. Expression CBDT is therefore not merely an administrative abbreviation. It refers to the statutory board responsible for what administration of the direct tax matter. It is not just a word. In a professional practice, CBDT is encountered through circulars, instructions, notifications, guidance, administrative directions, tax administration policy. So as a professionals or student, must we remember one thing, that an important legal principle: administrative circulars cannot override the statute. That is the one important crux. Administrative circulars cannot override the statute. So these operate within the framework of the act. Let's differentiate authorities and CBDT. So broad hierarchy of the income tax authorities has been written. Nothing has been changed on that ground. Principal structure changes, structural changes is section and numbering, and the primary example of continuity through the legislative restructuring. Let's understand legal representative. The expression legal representative is defined in section 2, subsection 65 of the 2025 Act by adopting what meaning assigned under section 2, subsection 11 of the Code of Civil Procedures 1901. So this is an important example of cross statute definition. The Income Tax Act doesn't reproduce the complete meaning. Instead, it says what? Look to the CPC. This is a common legislative drafting technique. The concept becomes particularly important when a taxpayer dies. So the tax administration must determine who represents the deceased, what assets are available, what liabilities can be recovered, and how assessment proceedings will be continued. So let's see legal representative income tax context. Suppose Mr. A dies after earning taxable income. Death of the taxpayer doesn't automatically extinguish the tax liability. Very important to know. So the law provides a mechanism through which the legal representative of the deceased assessee can participate in tax proceedings relating to the deceased. So the legal representative therefore acts in a representative capacity. This is a different from saying that the legal representative personally on the deceased personal income. The distinct principle here or crucial is representative liability is not equal to beneficial ownership. So this is the different from saying that the legal representative personally on the deceased person income, not at all. So let's see moving further the difference between the 1961 Act 2025 relating to this. So the definition has essentially been carried forward, nothing has been changed on that ground. So the definition appears under the new act while in section 2 subsection 65, while the special chapter dealing with legal representative begins with section 302. So the important point here is new act reorganizes the provisions but retains the cross reference to the CPC. Let's understand representative assessee. What is mean that? A representative assessee is a person who is brought within the tax administration framework in respect of income belonging to or connected with another person. So section 303 contains the general provisions that important situations include income of a non-resident, income of a minor or a person who is mentally ill or unsound mind, income received by a specified person such as trustees, receivers or managers for another person's benefit. So the representative assessee doesn't become the beneficial owner of the underlying income merely because the law takes that person responsible. That need to be kept in the mind. Who can be a representative assessee? Let's see. Section 303 covers several categories. Non-resident case, the agent of a non-resident, including a person treated as an agent under Section 306. Then the minor or a person of unsound mind, the guardian or a manager entitled to receive or actually receiving the income on behalf of the person. And the code-related cases, the provision also covers specified persons such as court of wards, administrator general, official trustee, receiver, manager, where they received or are entitled to what received income on behalf of or for the benefit of another person. So this is the statutory relationship. So it doesn't necessarily arise merely because two people have a private arrangement, right? Let's see representative assessee versus legal representative. So these two expressions are frequently confused very much. So have a focus on while listening this. A legal representative is a particularly relevant to the estate and a tax affairs of a deceased person, whereas a representative assessee is a broader income tax concept covering persons who are made responsible in respect of another person's income in specified circumstances. So therefore, every legal representative should not automatically be called as a representative assessee in every context. That need to be noted down. So the capacity in which the person acts must be identified from the statute only. So let's understand what are the liability of the representative assessee. So section 304 of the Income Tax Act 2025 provides the liability framework. A representative assessee in relation to the income for which his representative assessee is subject to what duties, responsibilities, and liabilities as if that income were received or accrued to him beneficially. So, however, the assessment is made upon him in his representative capacity. So, this distinction is what fundamental. So, the representative assessee is what effectively the statutory channel through which the tax system reaches the income or a person representing. Let's see what are the rights to recover tax from the representative assessee. So the law recognizes that a representative assessee may sometimes have to pay tax in relation to another person's income, but Section 305 gives the representative assessee is a corresponding right to recover the amount from the person on whose behalf it was paid, subject to the statutory conditions. So this is logical, and the representative is performing what statutory function. So the underlying economic burden ordinarily belongs to the person represented subject to the applicable tax provisions. So the Act balances the revenue protection with what? Representative protection. Moving further, let's see difference. So representative assessing framework has been substantially carried forward from 1961 Act to the principal correspondence is 1961 Act. So here section 303 under the 2025 Act. So now moving further, let's understand miscellaneous definition. Now moving to the miscellaneous definition. So who is liable to tax? So the expression liable to tax is particularly important in international. The expression liable to tax is particularly important in international taxation. Section 2, subsection 66 provides that in relation to a person and a country, it means that there is an income tax liability on that person under the law of that country. What? Section 2, subsection 66. In relation to a person and a country, it means that there is an income tax liability on the person under the law of that country. So importantly, it also includes a person who has substantially been exempted from that liability under the law of that country. So this prevents an overly simplistic argument that because I'm currently exempt from tax in that country, I can never be regarded as liable to tax. That is not. So the statutory definition must be examined. So let's see next, person of Indian origin under the miscellaneous definition. So section 2, subsection 78 defines person of Indian origin. It refers to an individual who or either of whose parents or grandparents was born in undivided India. So this definition becomes relevant particularly when applying to special residential status provisions. It demonstrates an important principle, a term that appears to be based on ordinarily identity may actually have a very precise statutory meaning. So therefore, the whatever the act uses person of Indian origin, the statutory definition must be what? Consulted. So please have that particular uh, thing in mind. As that whenever the act uses person of Indian origin, the statutory definition must be looked into. Moving further, principal officer, very important. So the expression principal officer is important in a tax administration and TDS. Under section 2, subsection 85 of the new Act 2025, it includes what persons such as secretary, treasurer, manager, agent of a company, local authority, association, or body. So it can also include a person connected with management or administration upon whom the assessing officer has served a notice of intention to treat that person as the principal officer. The concept is therefore functional. So it is not restricted to a person's job title. Very important. Now, prescribed and notification. So prescribed, what the two deceptively simple words are extremely important. So section 2 subsection 80 defines prescribed as a prescribed by rules made under the act. So therefore whenever a section says in the specified manner, we must look at the income tax rules. And under notification, the act defines notification as a notification published in the official gazette. So these concepts demonstrate the relationship between act, rules, notification. A professional must know which instrument supplies the operative detail. Now let's see PAN. What is mean by that? Permanent account number. Section 2 subsection 76 defines PAN, commonly called as permanent account number. It is a unique number consisting of 10 alphanumeric characters allotted by the assessing officer for identification under the Act. So the definition also includes a PAN allotted under the new series. PAN is not merely an administrative identifier. It is fundamental to return filing, tax deduction, collection, reporting, information matching, assessment, refunds. So the statutory definition gives what the number, its legal identity. Let's see Transaction, what is mean by that? For a transfer pricing purpose, section 173 clause E gives a wide meaning to the transaction. It includes what? An arrangement, understanding, or action in what? Consent. So whether or not formal, in writing, or intended to be enforceable by legal proceedings. So this is important because transfer pricing is concerned with what? Economic arrangements rather than merely formal contracts. So that is what is important of a transaction. Let's understand enterprise. Section 173 clause B defines enterprise broadly for the transfer pricing provisions. An enterprise includes a person, including a permanent establishment, that is P of such person engaged in activities such as production, storage, supply, distribution, acquisition, control of goods, intellectual property, lending, dealing in securities. So this wide definition ensures that transfer pricing provisions apply across the modern commercial structures. So now let's see episode's definition map. Who, where, then what, who, and who acts for another. So this is the conceptual map that I want to remember by the students and also by professionals. So the today's definitions can be organized around these five questions, right? Who, that is resident, non-resident, RNOR. Then where, India, foreign jurisdiction, permanent establishment. What transaction, international, specified domestic transactions. Then who administers, CBDT, income tax authorities, and who acts for another, legal representative and representative assessee. So this framework makes an otherwise what complicated set of definitions much easier to remember. So this is one of the factor to one can remember as it is. So I have done it for easy of reference. So now let's see a master comparison between both acts. The most important observation is that the most concepts have not been reinvented. New Act has reorganized the chapters, changed the section numbers, adopted the tax year terminology, modernized the drafting, and consolidated the related provisions. But the underlying architecture of residence, transfer pricing, representations, and tax administrations largely what continues. So let's see what common mistakes under the residential status. So five common mistakes we can say that assuming citizenship determines the residence. It is citizenship is not equal to residence. Then 182 days only is not a complete test. Then ignoring the special rules applicable to the Indian citizens and persons of Indian origin. Then failing to calculate the preceding 4 or 7, 10 years as required. Then stopping after determining the resident and forgetting to examine RNOR. So the correct professional approach is what? We need to ask whether residents, then ordinarily and resident or on RNOR. So first we need to identify whether resident or not. And then we need to move further ordinary resident or RNOR. So let's understand common mistakes under transfer pricing. So your transfer pricing creates another set of common mistakes like a transaction in US dollars is not automatically an international transactions. Currency is not important here. A transaction with a foreign person is not automatically an international transaction. We must examine what associated enterprise relationship, non-resident requirement, statutory transaction definition. Similarly, an as the special domestic transaction is not simply any related party domestic transaction. Section 164 contains a specific statutory list and rupees 20 crore aggregated threshold. So that need to be analyzed before come to the conclusion. Let's see common mistakes under representative associate. So another area of confusion is representation. Representative associate doesn't automatically become owner of the income. A legal representative doesn't automatically become what? Personally liable for every tax liability of the deceased without reference to the statutory provision. So the capacity must always be identified. So ask whose income is involved, why is the person representing him, which section creates the representative liability, what income is covered. So this approach prevents what? Overstatement of the liability. So now we're moving to the closing note. So today we have reached the end of our three-part journey of definitions, part one, part two, and part three today. So we begin this journey with a simple principle: before understanding a law, we must understand what its language. So in episode 4, we learn the basic vocabulary of the act. Then in episode 5, we explore the definitions relating to capital asset, business, profession, companies, firms. And today in episode 6, we completed the picture by examining the residential status, international transaction, transfer pricing, and tax administration. So we learn that resident, non-resident, resident but not ordinary resident are not the labels based on the citizenship. So they are statutory classifications. So we learn that residential status must be determined separately for each tax year and important to determine the tax liability. So Income Tax Act 2025, what we learn is that retain the core residential test while replacing the previous year terminology with the new tax year framework. So the official tax department guidance confirms that the basic individual residence conditions and RNOR criteria continue under the new act. So that is what we have covered in episode 6. Thank you so much for patient hearing. Hope you are gaining valuable knowledge from all these video series and updates that we are carrying on the Tax YouTube channel. If you are not yet subscribed Tax YouTube channel, then do subscribe it, and please note down my contact numbers. If you have any questions, suggestions, observations, then do let me know via WhatsApp, email, or you can also comment below the video. Thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.